Have you ever wondered how the stock market works? What those numbers and graphs you see on financial news channels really mean? Well, let's delve into that. The stock market, in essence, is a marketplace for buying and selling shares of companies. Now, what are shares? They are simply tiny slices of ownership in a company. When you buy a share, you're buying a piece of that company, betting on its future success. The stock market is the stage where this drama of buying and selling unfolds. It's an essential part of the global economy, influencing not just big corporations, but everyday people like you and me. Stocks can rise and fall in value, and that's where the opportunity to make or lose money comes in. Understanding the stock market isn't just for Wall Street wizards. Anyone can learn how it works and how to navigate it. So let's pull back the curtain and take a closer look. So, you might ask, how does the stock market actually work? Well, think of it as a giant supermarket, but instead of groceries, it's filled with shares of publicly traded companies. These are called stocks. When you buy a stock, you're essentially buying a small piece of that company, which makes you a shareholder. The stock market operates through a network of exchanges. Think of these as the checkout lanes of our supermarket. Some of the most prominent exchanges are the New York Stock Exchange and the Nasdaq. Companies list shares of their stock on an exchange through a process called an initial public offering, or IPO for short. This is their way of raising money to grow and expand their business. Now let's dive into trading. This is where the magic happens. Trading involves the buying and selling of stocks among investors. If you believe a company is going to do well, you buy their stock. If it performs well, the price of the stock goes up. If you then sell the stock, you make a profit. This is called a capital gain. However, if the company doesn't do well, the price of the stock falls. If you sell it then, you'll be selling it for less than you bought it for, resulting in a capital loss. Enter the brokers. They're the sales assistants in our supermarket analogy. They facilitate these trades for investors. In the old days, this was done in trading pits through open outcry, but now it's done electronically. It's also important to note that the stock market operates on supply and demand. If a lot of people want to buy a stock, demand is high, the price will go up. If a lot of people want to sell a stock, supply is high, the price will go down. So, it's a marketplace, a bit like your local farmer's market, but instead of buying vegetables, you're buying and selling parts of companies. Now that you have a basic understanding, you might wonder, when is the right time to buy or sell stocks? Well, the answer isn't as simple as it seems. It's influenced by a myriad of factors that you need to consider. Let's start with market trends. The stock market is a giant seesaw of ups and downs. It's a cycle of bull and bear markets. Bull markets are periods when stock prices are expected to rise, offering a good opportunity to buy. On the other hand, bear markets are periods of falling stock prices which might signal a time to sell. However, it's not just about following the crowd. You also need to look at the individual company's performance. Is the company growing or shrinking? Are its profits increasing or declining? Financial reports and earnings calls can provide insights into a company's health. If a company is outperforming expectations, it might be a good time to buy its stocks. Conversely, if the company is struggling, it might be time to sell. Yet, it's not all about numbers. External influences can also sway the stock market. Political instability, global events, or economic forecasts can affect investor sentiment and, in turn, stock prices. For instance, positive economic predictions can boost investor confidence, potentially making it a good time to buy stocks. On the flip side, periods of uncertainty can lead to stock market slumps, which might make it a suitable time to sell. It's important to note that timing the market perfectly is nearly impossible. Even the most experienced investors can't predict the market's every move. It's about making informed decisions based on the available information. To sum it up, the right time to buy or sell stocks depends on market trends, company performance, and external influences. It's about understanding these factors and making decisions that align with your financial goals and risk tolerance. Remember, timing in the stock market is everything, and making informed decisions is crucial. So keep your eyes open, do your research, and be patient. The stock market isn't a get-rich-quick scheme, but a platform for long-term investment and wealth creation. But as with any financial endeavor, investing in the stock market comes with its share of risks. Just as a ship venturing into unexplored waters faces the unknown, so too does the investor stepping into the stock market. The stock market, in all its glory, is a landscape riddled with potential pitfalls and rewards. It's an unpredictable beast, constantly in flux, driven by a myriad of variables, both domestic and global. From economic indicators and corporate earnings to political upheaval and natural disasters, these factors can trigger market volatility, causing stock prices to fluctuate wildly. Picture this: one day your stock is soaring, the next, it's in a free fall. This roller coaster ride, known as market volatility, can be nerve-wracking, but it's a part of the stock market experience. It's important to remember, though, that volatility isn't necessarily a bad thing. In fact, it can create buying opportunities for the savvy investor. But for the unprepared, it can also lead to significant losses. And that brings us to the next risk: the potential for loss. No investment is bulletproof. Even the most stable blue-chip stocks can stumble, and when they do, the financial impact can be substantial. You need to be prepared for this. Investing in the stock market isn't a guaranteed path to wealth. It's a calculated gamble. You're betting on the future performance of a company or a group of companies. If their performance falters, so too does your investment. So, how do we navigate these risks? Knowledge is your compass. Understanding the intricacies of the market, staying informed about global events, and keeping a close eye on your investments can help you weather the storm. Diversification is your lifeboat. Spreading your investments across a range of sectors can help mitigate potential losses. But perhaps the most important tool in your arsenal is patience. The stock market isn't a get-rich-quick scheme, it's a long-term commitment. It's about weathering the ups and downs, staying the course, and letting your investments grow over time. Risk is a part of the game when you're playing the stock market, but understanding those risks can help you play the game a bit better. So how can you protect yourself and your investments in this unpredictable market? That's the million-dollar question, isn't it? Well, let's dive right in. The first thing to remember is, don't put all your eggs in one basket. This old adage rings true even in the stock market. Diversification is key. Spread your investments across different sectors, companies, and asset classes. This way, if one investment doesn't perform well, others might still keep you afloat. Next, knowledge is power. Before you invest in a company, do your homework. Understand the company's business model, its financial health, and the industry it operates in. Look at the company's earnings reports, read news articles, and listen to what experts are saying. Don't just follow the herd. Make an informed decision. Another crucial tip is to avoid making impulsive decisions based on market rumors. The stock market can be a roller coaster of emotions. It's easy to get swept up in the frenzy and make rash decisions. But remember, panic selling or buying based on hearsay can lead to hefty losses. Stay calm, think logically, and stick to your investment plan. Also, don't be afraid to seek professional advice. Financial advisors can provide valuable insights and help you navigate the complex world of investing. However, ensure that your advisor has a fiduciary duty to act in your best interest. Lastly, remember that investing in the stock market is not a get-rich-quick scheme. It's a long-term commitment. Patience is key. Over time, the stock market tends to rise despite short-term fluctuations. Invest with a long-term perspective, and don't let short-term market volatility deter you from your investment goals. In conclusion, being safe in the stock market is not just about avoiding losses. It's about making informed decisions, managing risks, and staying committed to your long-term investment goals. As the saying goes, the stock market is a device for transferring money from the impatient to the patient. So be patient, be informed, and be strategic. Safe investing is all about informed decision-making and strategic planning. So, there you have it. A beginner's guide to understanding the stock market. We've explored the fundamentals of the stock market, shedding light on its mechanisms, the forces that drive it, and its integral role in our global economy. We've also delved into the strategic timing of buying and selling stocks. Remember, it's not just about buying low and selling high, but also about understanding market trends, economic indicators, and your personal financial goals. We've talked about the risks because yes, they are very real. But don't be discouraged. Risks can be managed and mitigated with careful planning, informed decision-making, and a healthy dose of patience. And finally, we've shared some tips on how to stay safe while navigating the stock market, emphasizing the importance of diversification, ongoing education, and not letting emotions drive your decisions. Remember, the stock market is a complex beast, but with knowledge and careful strategy you can tame it. Happy investing!